Hey, it's Kristi. Thanks so much for joining me for another video. In this episode, let's talk about what is and is not reported on your credit report. I would like to start off also by saying I have a podcast called Credit Coaching by Kristi. So if credit is really important to you, if you're looking to build it, repair it, just improve it upon where it is right now, I invite you over to the podcast world. Again, it's Credit Coaching by Kristi. So let's dive in. Let's talk about what is and is not reported on your credit report. So let's start with what's not reported on your credit report. Your marital status is not reported. Doesn't matter to anybody if you're married, not married, divorced, single, widowed, really doesn't matter. It is important on a loan application if you are applying for debt, typically with a mortgage loan application, but as far as credit reporting purposes, it doesn't have any effect and it's not reported there. Also, what is not reported is your income. This is surprising to a lot of people because you would think that the amount of credit that is available to us or what we might be approved for should be reported, but it's not reported anywhere. Now, if you report to your bank what your income is, that's a different story. That's where they're calculating, should we increase that credit card balance? Should we offer them a loan? They're just trying to get a financial snapshot of everything because there's a really good chance you don't have all of your money sitting in that one bank account, right? So they're just trying to get a better idea of your overall household income. But the credit reporting bureaus, they don't know. So it's not reported as far as your income. Another thing that is not reported is your net worth or your equity in the things that you own. So what is equity? Equity is that difference between the value of something and what is owed against it. So nowhere is there reported equity, and we'll talk about what is reported when it comes to loans, but nowhere does it say your net worth or your equity. So your net worth are any debts that you have out there minus the things that you have that are of value, such as a house, a car, a business, something along those lines. So now that we know what's not reported on your credit report, let's tackle what does get reported. Obviously, any loans or lines of credit that you have out there. So what falls under the loan category? That's a mortgage, your auto, your car loan, your personal loans, and student loans. Now, if you have a personal loan with Aunt Mary hanging out there, unless it's recorded in public records someplace, or she physically went to a bank and they instituted this loan on her behalf, it's not out there being reported anywhere. So it is just, lender leveraged loans to you and any credit cards. So what's really cool about installment loans is they start off with the amount that was borrowed and it shows your current amount. So over time, you'll see that going down, unless of course it's like a student loan and you have it in deferment. That's where it can kind of hurt you a little bit because if you have it in deferment, that interest is still accruing, and that means you likely have a larger amount owed than what was originally loaned to you. So in that case, it looks like you're a little upside down. Now, this is where the debt utilization comes into conversation with credit cards. So credit cards, they're revolving accounts. There's a limit and a balance. You really want your balance to be 30% or less than what the limit is out there, or otherwise it looks like you're kind of over leveraged on what monies you're borrowing. And that can hurt your credit score, can have a negative impact on your credit score. So with those lower balances, we get to see, again, a healthy mix of debt utilization. So what's reported is your limit, how much you have out there at the time that the credit card company had reported. So it was during their bill cycle. So if your bill cycle, let's say your due date is the 19th of every month, around that time is when they are reporting it to the credit reporting bureaus. I had a misconception that on the 1st of every month, it was just a clean slate, wipe clean, and then now your new debts are reported. And that's actually not the case. Your mortgage is typically reported at the first-ish of the month because that's when your payment is due. A really neat feature inside of credit reports is what's called a trended report. We get to see the last 24 months worth of payments. And why this is important is because when you go and apply for debt, that decision maker that you are applying with is likely going to look at your 24 months worth of payment history. Obviously, it's got to be on time. That's really important. But another feature is, are you just making those minimum payments? So if you go and spend a couple $100s a month on gas and groceries on your credit card, are you paying more than that minimum amount, or are you only paying that barely able to scrape by minimum amount that's only paying your interest, and then your balance is accruing and growing because you're still using that credit card? Or are you tackling it with really large payments and being a good borrower in their eyes, that you're managing your money well? So that's one of the things they look at with a trended credit report. So another thing that is reported on your credit report are any liens. Let's say you haven't made payments for taxes owed to the federal government and you haven't made an arrangement with the IRS. Now, if you have a payment arrangement with the IRS, it's likely not going to show up on your credit report because you're in an agreed upon repayment schedule. But if you haven't, and from years gone past, they might put a lien out there against you personally. They can put a lien against your property. If you haven't paid property taxes on the home that you own or any real estate that you own, there could be a lien out there against that property. Let's say you had a collection that turned into, say, an automobile repossession. That company that's owed that money could actually go and put a lien against you. So that is in the public records portion of your credit report. Other things that show up in your public records section of your credit report are foreclosures, short sales, and bankruptcies. So that is a public record. It's also known as a derogatory event, and that can be left on there for years and years. I've seen it for up to 10 years since that derogatory event had occurred. So the older it is, typically the less hit or impact, negative impact it has to your credit scores, but it can be listed there. And if you had, let's say, a foreclosure or a bankruptcy in the past, and you're now applying for a new mortgage loan, it's going to be really important to that decision maker, who's called an underwriter, to know what happened in that moment. It's going to make your application much stronger if you write a letter of explanation stating how it was a one-time event. It's not going to happen again. It wasn't a mismanagement of money. Something really terrible happened and you just had no way out. That was the only way that you could go. So a lot of people that had gone through short sales, bankruptcies, foreclosures, through the Great Recession in 2008, 2009, that has really fallen off of credit reports now. So in addition to the original loan amount or limit that was given to you and the current balance that is being reflected, the payment and the terms show up. For instance, if you have an auto loan payment out there and your car payment is $400 a month and it's for 72 months, those terms are going to show. But what does not show is the interest rate. But by knowing the original loan amount, your monthly payment, and the term, we can solve for X and figure out that interest rate if we needed to. But on credit cards and installment loans, the interest rate is not reflected on your credit report. And then your payment history. It's so important because that makes up 35% of your credit score. And it's really important when somebody is making a decision on if they're going to loan you money. And that's huge when it comes to applications for like an auto loan or for a mortgage, is your ability to borrow money and pay it back on time. That's simply all your credit report is a snapshot in time of that ability to manage of those debts that have been loaned to you in advance, and your ability to manage those payments and make those payments on time. And the last thing that I will talk about that is added on your credit report is inquiries. So inquiries, there are two types of inquiries. There's a soft inquiry and a hard inquiry. A soft inquiry is when you are checking your own credit. It doesn't impact your credit score because you're not applying for debt. A hard inquiry is when you are applying for debt. So if you are applying for a mortgage loan, a car loan, a credit card, even an existing credit card, but you're looking to increase that limit that is available to you, that's going to fall under the hard inquiry section there. A soft inquiry is going to be, like I said, where you pull your own credit just to manage it, say through Credit Karma or Equifax or something like that. Also, when you are maybe securing new auto insurance, or you've just recently moved, or you're getting ready to move and you need to secure utilities. A lot of times the utility companies will do a soft pull on your credit just to make sure that you haven't stuck a whole bunch of people out there with utility collections, that you're paying your bills on time and that they can loan it to you. Because even though it's not technically credit, you are using those resources and then paying it back after you've used it. So they are kind of giving you an extension or a line of credit that way, but it doesn't fall under the category of a credit card or a loan or anything like that. So that's why it is a soft inquiry. Soft inquiries do not have an impact on your credit score. It's okay. It's where you have the hard inquiries where you're applying for different types of loans out there. And if you have a big mix, now you can look like a really big risk. So let me explain what I mean by that. Let's say you went and applied for a mortgage loan, and then all of a sudden your car breaks down. You're like, I am so tired of putting money into this car. I'm going to go and get a new car. And now you went to a couple of different dealerships. They pulled your credit several times. That's a different kind of inquiry because the first one was for a mortgage. This time it's for auto finance. And then let's say you go, you know what, I'd really like to have a new credit card, one with points, because I want to travel. And now you've gone online and you've applied for one of those travel point credit cards. Now that's a third type of inquiry because it's for a credit card, and every single one is labeled a little bit differently. Well, now in the eyes of the credit reporting bureaus, you could appear like a credit risk because you're all of a sudden grabbing all of this new credit. So what if you just gobbled it all up and then just took off? So that's why it's really important that you pace yourself on your credit inquiries and try not to get a whole bunch of credit at one time because it could have a really negative and adverse effect on your credit score. Hope this clears up some questions that you might have had about what is reported and not reported on your credit report. Thanks so much for being with me. And if you haven't already, please subscribe to this channel. I appreciate you being here. I'm Credit Kristi, and I make money simple.